I look at the financial district of Lower Manhattan today, and I see something that should deeply concern every American who understands how national power actually works. What disturbs me is not what remains. It is what has vanished. For more than a century, Wall Street represented the nerve center of global capitalism. The trading floors, the brokerage houses, the concentrated ambition packed into those narrow streets. This was where the American economy set prices for everything from Midwestern grain to Asian semiconductors. That pulse has not stopped. It is simply relocated. If you want to find the heartbeat of modern finance today, you will not find it at Wall and Broad. You will find it 400 meters northwest in Toronto. This is not metaphor. This is documented fact. In what may be remembered as one of the most damaging self-inflicted economic wounds in American history, the United States has surrendered its position as the world's financial center to Canada. We are witnessing a capital exodus that future historians will likely compare to the shift from London to New York after the First World War. But this transition was not caused by military conflict, economic depression, or resource discovery. It was caused by a tax, specifically a 0.5% transaction tax championed by President Donald Trump and enacted by a populism-driven Congress. Designed to punish speculators, it has instead dismantled the foundation of American financial dominance.
Long-term investors holding retirement accounts for decades, this might be absorbable. But for the market makers who provide the liquidity that stabilizes prices, firms that buy and sell millions of shares hourly to ensure there is always a counterparty for your transaction, it destroyed their economic viability. These operations function on margins often measured in fractions of a cent. A 0.5% tax did not merely reduce profits. It exceeded gross revenue on virtually every trade. The Financial Accountability Act went further. It erected barriers against international capital driven by an America First logic that interpreted foreign investment not as validation of the American economy, but as extraction. The legislation raised capital gains taxes on foreign investors from 20% to 35%. The argument was straightforward and superficially compelling. Why should a Norwegian sovereign wealth fund or a Singaporean pension system profit from American innovation while paying lower taxes than American workers? It was a rhetorical question that ignored economic fundamentals. The reality is that the United States has long depended on foreign capital to finance deficits and maintain low interest rates. By increasing the cost of accessing American markets, we did not prioritize American citizens. We simply instructed the rest of the world to invest elsewhere. Compounding this legislative assault was deliberate erosion of regulatory predictability. The administration appointed Securities and Exchange Commission officials who viewed the AY's traditional frameworks not as necessary guardrails, but as obstacles. The result was not deregulation in any conventional sense. It was regulatory chaos. Rules changed with bewildering frequency. Enforcement became arbitrary. A trading strategy compliant in March might be deemed illegal and may based on retroactive interpretation of an obscure guidance document. Corporate boards and compliance officers who prize certainty above nearly everything else found themselves navigating a minefield where the danger zones shifted daily. Then came the cryptocurrency decision. In a move that stunned the financial technology sector, the administration banned all cryptocurrency trading within United States borders, citing money laundering and criminal activity concerns. Exchanges were shuttered. Trading was criminalized. Whether one views cryptocurrency as the future of currency or speculative mania is irrelevant to the institutional consequence. An entire asset class and the emerging infrastructure of blockchain technology supporting it was legally expelled from American territory. The innovators, the developers, the capital associated with this sector did not cease existing. They purchased plane tickets. The cumulative effect of these policies was mechanical failure of American financial markets. It occurred faster than anyone in Washington anticipated. The transaction tax immediately killed high-frequency trading. You might feel no sympathy for high-speed traders, but you experience the consequence of their absence. When they shut down operations because the tax made their business model impossible, liquidity collapsed. The bid-ask spread. The gap between what a buyer will pay and what a seller will accept widened dramatically. Price discovery became inefficient. Suddenly executing a trade in New York was not only more expensive due to the tax, it was riskier and slower because the market had become thin and fragile. Simultaneously, foreign capital flight accelerated. Sovereign wealth funds from Abu Dhabi, Norway, and Singapore managing trillions in assets began liquidating American holdings. They are fiduciaries with legal obligations to maximize returns and minimize unnecessary costs. Facing a 35% tax rate in the United States versus substantially lower rates elsewhere, they did the only responsible thing. They withdrew. The outflows were massive, hundreds of billions departing the American financial ecosystem in the first year alone. This selling pressure drove asset prices downward, meaning that the retirement accounts and pension funds of ordinary Americans, the very people this policy was supposedly protecting, began contracting. Collateral damage in a war against a caricature. Regulatory uncertainty acted as the final accelerant. Major institutions like J.P. Morgan and Bridgewater cannot operate without foundational stability. They plan across 5- and 10-year horizons when they realized the United States could no longer guarantee basic consistency in financial regulation. They stopped investing in New York infrastructure. They stopped hiring. They stopped upgrading systems. They began seeking a jurisdiction that offered what America had abandoned: stable, predictable, competent governance. They found it across the northern border where a very different philosophy was taking shape. While American finance buckled under populist retribution and regulatory incoherence, Canada was constructing the alternative. Mark Carney, who understands global financial infrastructure perhaps better than any living policymaker, recognized a fundamental truth that Washington seemed to have forgotten. Financial markets are not casinos to be closed or piggy banks to be raided. They are essential infrastructure of capitalism. They allocate capital to productive enterprise. They price risk. They enable governments to finance operations. Carney understood that if the United States was determined to make financial business unviable through punitive taxation and chaotic governance, Canada could simply create conditions for it to flourish. That is precisely what occurred. Carney announced a comprehensive financial services expansion strategy that was remarkable in its clarity and boldness. He did not offer subsidies or bailouts. He offered rationality. First, he guaranteed zero federal taxes on financial transactions. Not reduced rates, zero. If you traded stock in Toronto, the government extracted no fee from the principal. Second, he maintained Canada's capital gains tax for foreign investors at 15%, less than half the new American rate. Third, and perhaps most attractive to firms drowning in American red tape, he streamlined licensing procedures. He established fast-track protocols allowing regulated American firms to transfer operations to Canada in as little as 48 hours. Regulators, brokers, compliance officers could have credentials recognized almost immediately.